Hello, and welcome back to our continued discussion on costs. This is all foundational, so the better you understand this as we move forward, you'll do much better. We're going to keep going with our discussion on cost, introducing some new concepts and new terminology. The basic cost that we discussed in part one of cost remains fundamental. We're breaking it down. And what we look at is, in the case of the guitar company, there's direct materials which are referred to as prime costs, and then we have direct labor and factory overhead, which are conversion costs. So think about it that there's those two types. There's the actual material, and then there's the conversion. And prime costs are very specific. Conversion costs are direct labor and factory overhead costs. So there's that mix that goes in there. Next thing to introduce is what we will call product costs, which are the manufacturing costs that we have been talking. Then we're talking about period costs. Okay, they don't directly relate to the product. And that's the selling and administrative expenses. And selling expenses are incurred in the marketing and the distribution of the product to the customer. Administrative expenses are incurred in managing a company. They're part of doing business. We can't attribute them specifically to a product. You'll see why as we move forward. And in this piece with Legend Guitar, direct materials cost, wood used, neck and the body. Direct labor, well, that's the wage of the saw operator. Wages of employees who assemble the guitar. What are some of the overhead things? Guitar strings, yeah, that probably could be there. I would do that. But wages of the janitor, power to run the machines, depreciation expense on the machines, sandpaper and buffing materials, glue, production supervisor. So these are the product or manufacturing costs. Okay, we could substitute the word merchandising for manufacturing here. Same thing. Period, non-manufacturing, selling expense, advertising, sales salaries expense, commission expenses. Then we have administrative expenses, office salaries, supplies. This is where your human resources costs go, your technology, IT department, your audit, your legal. They're period costs. So we want to, when we're looking at costs, distinguish between product and period, because the accounting is different. When we look at the accounting, product costs are first reported, they flow through the balance sheet to get to the income statement. Period expenses are directly in the income statement in the period in which the expense occurred. Back to the matching principle that I talked about in Module 1. So if we look at how the manufacturing costs work, which if we go back just one screen, these are the product costs, it starts with you got direct material, direct labor, factory overhead. Okay? So at the end of any reporting period, you may not have used all of the direct materials. You may have some inventory. So that's classified on the balance sheet as materials inventory. Direct labor goes into the manufacturing process. Factory overhead goes in. But then there is unfinished work. Okay, so you got unused, unfinished. This is where the product may not be completed yet. Okay, so in the coffee bean example, Geneseo Coffee Company, you may have roasted the beans, but you may not have bagged them. In the example of the Legend Guitar, you may have cut the pattern in the wood, but you have not glued it. You may not have varnished it or sealed it. Then finally, the last one are finished goods. These are ready to go to the customer. So if we're, and that goes to finished goods inventory. It doesn't hit the income statement until we move it out to cost of goods sold. So we're looking at this. Here's the costs. They either go direct, if we don't use all the direct materials, it goes into materials inventory. All three of these come to the manufacturing process. They're either unfinished, and we still at work, called work in process, or they're finished in finished goods inventory. Only when it's finished do we move it to cost of goods sold. So the flow chart, I think, here is very important for us to get our hands around, because these are, we're trying to get the pricing right, evaluate our profitability, so we want to make sure that these are properly classified. Now, don't forget, cash flow goes out at different pieces here, and if the cash isn't coming in, you have to fund it, but cash doesn't come in until after you sell it and get paid. So let's just keep looking at this concept of inventory, and we're getting over to a little bit of financial accounting, but a merchandising business reports only merchandise inventory. What do they have? So if you go to a grocery store, at the end of every period, they count how much of everything they have. That's your inventory. It's not broken down into the raw materials, work in process, or finished goods. Okay. Now, a manufacturing business has all three of these on their balance sheet. Okay, so we're looking at the flow, and this is going to come into play when we start looking at cash flow next week. So this is what we just talked about: materials inventory, sometimes raw materials. I'll use probably raw materials more than everything else. Work in process, finished goods, ready to go. So that's inventory. Now, how does it make its way to the income statement? Well, there's a statement of cost of goods manufactured, okay? And when we look at it, we start out with beginning work. This is, oh shit. Okay. When we look at the cost of goods manufactured, what we start with, if you think about this conceptually, think about it from a process flow. We start out with a beginning work in process inventory. Okay, what was there? We then add in the beginning materials inventory. Okay, let's start again. So when we look at this, what we want to do is determine the cost of goods manufactured. So we start with what was in process at the beginning of the period, because it's not done. We then look at the direct materials. These are the variable costs. Beginning materials inventory, we haven't used. How much did we buy will tell us how much we have to use, less the ending inventory will tell us how much is used. We then have a direct labor, factory overhead, total cost incurred, and mass manufacturing cost, which is the beginning in process plus the period cost relative to manufacturing. We then subtract the ending work in process inventory, and that gives us cost of goods manufactured. Now, when we look at this, and this is where it comes out, is that we have income. This is the income statement effect. So in merchandising business, retail, you have sales. You start with beginning inventory, net purchases, that's what's available for sale. Less ending inventory is our cost of goods sold. The difference between sales, less cost of goods sold is our gross profit. Okay. Now, when we look at manufacturing, it's just a little bit different, is we start out with beginning inventory, finished goods, cost of manufactured goods, cost of finished goods available for sale, ending finished goods inventory, that gives us cost of goods sold. So essentially, it's walking you through the differences between breaking it down into where it is in the manufacturing process instead of just a value at the end of the period. Because in a retail business, we know the materials are good, that they're ready to go. Now, if we look back to the manufacturing, it's important for us to know what's sitting in just materials, because it's not really sellable in the same form. because there's not value added. So this is what where income statements are going to look like. And we'll be exploring these as we go along. So let's again, this is the accounting side, is if you're looking at the costs, what we've paid for generating revenues, we break them down into the product cost and period. Okay? We know that product costs have to run through the balance sheet before they get to cost of goods sold. Basically a control. Then the period costs go directly to the income statement without going through the balance sheet. Now that we got that done, you got this sense, we've looked at revenues, changes in revenue, how revenue changes. We looked at the different types of costs. We focused in on direct material, direct labor, factory overhead, periodic costs, product costs. We looked at variable costs, fixed costs, remembering over a period of time, everything is variable. We then looked at mix, which are these unique contracts that get in there. We then looked at how do we account for them. Manufacturing costs run through the balance sheet, through cost of goods sold into the income statement. A merchandising company goes directly with the value of that inventory. Beginning inventory, less purchases. Beginning inventory plus purchases, less ending inventory is cost of goods sold, because of the nature of what's in the inventory on a manufacturing basis. Doesn't have all the value added. Now that we got that, let's look at cost behavior. How do costs behave in relationship to that revenue? Okay, that activity or that driver, as I had said. So when we use the word cost behavior, it's how a cost change is a related activity change. Okay? And it depends on the following. One, identifying the activities that cause the cost to change. And these activities are called activity bases, activity drivers. We're keeping them very simple for this course, the volume. And you specify the range of activity over which the changes in the cost are of interest. So this is where time starts to come in. It's called the relative range. I would say it's time. Okay, so you want to look at what time period we're looking at how these costs behave. Because on a long-term basis, everything is variable. Okay, but we want to look how they behave within a range, which we define. So we look at these elements of cost behavior: fixed cost, variable, and mixed costs. So when we look here, let's just start with this one up here. Fixed costs, costs that are unaffected by the company's volume. Variable costs are costs that are directly linked to the company's volume. Raw materials, shipping costs, commissions. Fixed costs are not affected by the company's volume, within limits. We'll talk about that. Rent, insurance, equipment. So our formula for variable cost is the quantity of the output times the variable cost per unit of output. So now let's keep coming back over here and look at it a little different. Again, repetitive. Fixed costs are those which are not output dependent, are fixed to a certain level. The unit changes with output. We'll look at that in a graph. Variable cost, totally dependent on the output. Positive correlation between the production output and the variable. The variable cost per unit remains constant. Okay? And this is going to enable the manager to understand the break-even point as in both dollar terms and unit terms, but also to help in that pricing decision to maximize profitability. Okay? And we can then look at it to see the adaptability of the company, and what happens, like in this COVID-19 situation, is some of the variable cost of the company isn't selling the product. Those variable costs aren't there. But it's the fixed costs that they still have to incur. So we want to understand this because we're making decisions. Okay? Another example of fixed cost, again, it's repetitive. You probably would think, why is he going over this? One, because hopefully it sticks. Rent, weekly payroll, within limit if it's not tied to the direct labor. Okay? Equipment depreciation, variable, your delivery, sales commission, advertising. So when we go look at companies, if we were to look at companies after COVID-19, we'll get a real sense of how their costs are. So if you didn't see a payroll, or you didn't see expenses declining over the past 3 months, we could say, well, perhaps these companies kept everybody on for fun. They're generous. Or they weren't impacted. Business continued on. So we would take a look at them. So let's look at the Geneseo Coffee Company. Variable costs. Raw beans. If I sell 5 pounds of beans, I need 5 pounds of raw beans. Coffee flavorings. I'm only going to put the coffee flavorings are going to be a function of how many beans I roast. Bags. Okay, so if I roast 100,000 raw beans and I'm going to package them in 16 ounce pound containers, I'm going to need 100,000 bags. Okay, so they move direct relationship. The sales commission, sure. Marketing costs. Okay, I can make a decision on marketing. Shipping costs. The more I ship, the more it's going to cost. Electricity for running the machines. The longer the machine runs, the more electricity it uses. And we're only going to run that machine when we're roasting coffee beans. Our fixed cost, building and equipment, supervision, management fees, audit fees, legal fees, HR fees, technology fees, executive salaries, those are essentially fixed within reason. So here's a couple of others using this activity base, also known as drivers volume, unit volume. University here, instructor salaries. I guess it's a function of the number of classes, except in the summer, when it's classes plus how many of you there are. That's sort of a mixed cost. We'll talk about that in a moment. Passenger airlines, it's fuel, number of miles flown. So the more you fly, the more fuel is used. Manufacturing, the direct material, number of units produced. Hospital, nurses' wages, function of number of patients. Hotel, housekeeping, okay, number of guests. Bank, teller wages. Well, how many transactions are they processing? So these are all variable costs. Some of them are in product cost and some of them are in periodic cost. But when we're looking at a company and trying to understand it to make management decisions, we need to look at them, both direct product cost, cost of goods sold, and periodic cost have that same variability versus fixed. Okay. Then we have fixed cost, and they remain the same in total dollar amount as the activity base changes. So it's fixed within a time framework. Okay. There's limits to growth. Keyword, limits to grow. Only grow to the extent the equipment has the capacity. In Geneseo Coffee Company, if each machine has a capacity of 100,000 beans, I can't produce more than 100,000 with that existing equipment. So I would need more equipment to go over 100. So it's fixed within that time period. So it's running at 80% capacity. I can increase that, okay? I can run more through it and my cost of the equipment will not change. So when we look at fixed costs on a graphic basis, I think this is a pretty good way of looking at it, is that the total fixed cost remains the same over a certain level of units. Okay, that's this right here. Now, if we produce more units, the unit fixed cost goes down. So fixed cost is fixed over this time horizon, or the units produced. Here, the unit fixed cost per unit sold goes down. Okay, and this is where we start to get into profitability analysis. Here's some more examples. A university, it's buildings, activity-based, number of students. Passenger airlines, depreciation, number of miles flown. Manufacturing, you can go right down the list and look at that, but they're basically fixed over a time period within limits. When we look at this, a variable cost increases and decreases proportionately with activity level. It remains the same regardless of activity level per unit. Okay? Remains the same regardless of activity level, and increases and decreases inversely with activity level. Having you go through and understand this, it is in the book to take another look through it. You might just think this might be a really good quiz question. Then we get to mixed costs. I don't. This is getting finer, but the characteristics of both variable or fixed, semi-variable, semi-fixed. I don't mean to confuse you on these. They're there. You should know the terminology. Is it used as much? No, not at all. And mixed cost is sometimes you rent equipment and the rental charge is a fixed amount and then you get an overage charge. Okay? In this case, I'm using this as an example. Base fee, $15,000 a year, $1 for each hour used in excess of $10,000. If we look at leases, we may have a lease payment on a personal car for $300 a month, which gives us $300 a month over 36 years, 36,000 miles. Now, if we go over that 36,000 miles, we're going to pay an additional amount, okay, mileage overage. And that's essentially what these are. And they are prevalent as people lease equipment, and that's when we get into financial statement analysis and managerial finance. We'll take a bigger in-depth look there. And by the way, we are doing that over Intercession 2021. So if you need to take it and you like how this format works, well, take 311 because it'll be based on what we're doing. It flows real nice, and you can get that out of the way. That's just a sales pitch because I'm always trying to sell. So this is an example here that if they use 8,000 hours, that's just 15. Now, however, if I keep going up, up, and up, I'm getting more rental charge. So it's semi-variable. If we look at this on a graph, it's fixed over a volume amount, but then it goes up after that. And that's our mixed costs. And mixed costs, when we look at it, there's a variable and a fixed component. So if you're looking at this from a utility cost, you got that fixed monthly cost of bringing the power in. Then the variable piece is what takes us to the mixed cost, because it may be based on usage, which is going to be based on the amount of utilities used to run the machine. Now, I know this was a little longer video, but hopefully we've laid out what you need to know about cost that's foundational. We're making really good progress. If you have any questions, please let me know.